Most people don't lose money because they're lazy or irresponsible. They lose money because they're late. Late to notice change, late to adjust habits, late to understand where money is quietly moving. And 2026 is shaping up to be one of those years where small shifts today can make a big difference later. In this video, I'm going to walk you through 4 money trends you should know about in 2026. Not hype, not guesses. Real changes already happening that will affect how you save, spend, invest, and earn. If you understand these early, you don't just react to the future. You position yourself ahead of it. The first major trend is that AI is finally moving from buzzwords to your bottom line. For years, AI sounded impressive but distant, like something only big tech companies used. That's changing fast. By 2026, AI is becoming a quiet partner in everyday money decisions. Budgeting apps are no longer just tracking what you spent last month. They're predicting what you're likely to spend next month. Banking apps are starting to warn you about fees before they happen, not after. Robo-advisors are getting better at tailoring investment strategies based on your behavior, not just your age. This matters because most financial mistakes come from not seeing problems early enough. AI shortens that delay. Imagine an app that notices your spending rising before you do, or flags cash sitting idle that could earn more. The real shift here isn't robots replacing humans. It's AI reducing friction, confusion, and missed opportunities. And the people who benefit most will be those who use these tools intentionally, not blindly. The open question is this: if AI can guide money decisions better than emotion, will you let it help or ignore it until others get ahead? Based on current research, leveraging AI for financial decisions is increasingly viewed as a crucial tool to mitigate emotional biases like fear, greed, and overconfidence, which often lead to poor financial outcomes. Studies suggest that AI can enhance financial literacy, automate savings, and provide objective, data-driven recommendations, with nearly 2 in 3 financial planners already reporting the use of AI in their firms. The second trend is interest rates slowly moving lower. And that sounds boring until you understand the impact. After the rate cuts in 2025, forecasts point to gradually lower rates into 2026. Mortgage rates, which recently lived in the 6 to 7% range, are projected to move closer to around 5.9% by the end of 2026. Interest rates are on a generally lower trajectory following rate cuts in 2025, with forecasts pointing toward further, gradual declines into 2026. This shift from a high-interest environment to a more accommodative one is intended to manage a slowing labor market while balancing against persistent inflation. Short-term yields may also decline if easing continues. This matters because many people have gotten comfortable earning high interest on cash. High-yield savings accounts and money market funds have felt generous. But those yields are not permanent. As rates move down, the reward for simply holding cash shrinks. That doesn't mean cash becomes useless. It means strategy matters more. Locking in fixed rates, understanding timing, and balancing liquidity with growth becomes more important.
Finance only through the lens of math is extremely naive. You're leaving out all of the implications in your life of this mathematical decision.
People who assume today's rates will last forever may be surprised. The smart move isn't panic or rushing into risk. It's awareness. Because when the environment changes, the same behavior produces different results. The third trend is what I call the side hustle economy 2.0. Side hustles aren't new. What's new is how easy they're becoming to start and manage. In the past, starting a side business meant paperwork, invoices, marketing headaches, and administrative stress. In 2026, AI-powered tools are removing much of that friction. Invoicing can be automated. Proposals can be generated in minutes. Marketing content can be drafted without starting from scratch. Apps are now helping individuals track income, categorize expenses, and even run business scenarios using simple conversational prompts. This matters because barriers stop people from starting. Lower the barrier, and more people participate. The real opportunity here isn't working nonstop. It's flexibility. A small, well-managed side income can act as insurance in an uncertain job market. It can also become leverage, not just extra cash. The question isn't whether everyone should start a side hustle. It's whether having a second income stream will become the new normal rather than the exception. In 2025, millions of people stopped depending on just one salary for their financial security. Rising living costs, uncertain jobs, and easy access to online opportunities encouraged workers to create multiple income streams. This shift brought greater stability and control over their money. Building extra sources of earnings became a smart way to handle life's ups and downs. The fourth trend is quieter, but it affects real money. New tax rules in 2026. The One Big Beautiful Bill Act, signed in July 2025, makes many 2017 tax provisions permanent and introduces small changes that start in 2026. On the surface, small tax changes don't sound exciting, but over time, they add up. Slight adjustments to brackets, deductions, or credits can mean keeping more of what you earn or losing it without realizing why. This matters because taxes are one of the biggest expenses most people never actively manage. People focus on income, but forget about efficiency. Understanding tax changes early allows better planning around savings, retirement accounts, and side income. The difference between reacting at tax time and planning ahead can be thousands of dollars over a decade. And most people won't notice until it's too late. Highlights common human tendencies to take things for granted, neglect important issues like health, relationships, or personal growth, and only recognize value or consequences after they're gone or irreversible, often leading to regret for lost time, opportunities, or irreplaceable people. When you look at these four trends together, a pattern appears. Technology is reducing friction. Rates are reshaping incentives. Income is becoming more flexible, and rules are quietly shifting in the background. None of this requires panic, but it does require attention. The future rarely announces itself loudly. It shows up gradually, rewarding those who notice early and punishing those who assume tomorrow will look like today. IS impact on the economy is judging when its impact will become sufficiently significant to show up in macroeconomic statistics. Predicting the point at which any technology starts to become widely adopted is inherently difficult, so we explore a range of timing assumptions in our analysis. Here's the key takeaway. You don't need to predict the future perfectly. You just need to stop being surprised by it. Use tools that help you see clearly. Don't assume current conditions will last forever. Build flexibility into how you earn and plan. And pay attention to rules that quietly shape outcomes. If you want to stay ahead of money trends like these and understand how they affect real life, not just headlines, watch the next video on this channel. This is FinWisdom Mastery, and here we focus on how money actually works, not how it's marketed. See you in the next one.